Hold on to your hats. Get this. The average dividend yield for the S&P 500 just hit 3%. That's right, folks. A full 3% return on your investment, just for holding on to solid companies. This is huge news. We haven't seen numbers like this in years. It's a golden age for dividend investors. We're talking about cold, hard cash flowing right into your pocket just for owning a piece of these companies. It's like getting paid to own a slice of the American dream, and the best part? This is just the beginning. Let's face it, the market can be a wild ride. It's like a roller coaster, full of ups and downs. But here's the thing about dividends. They bring in steady income no matter what the market is doing. They're your safety net. Think of it like this. When you invest in dividend-paying companies, you're not just betting on their stock price going up. You're investing in their ability to generate real profits and share those profits with you. That's why dividend investing is so powerful. It's a long-term game plan. It's about building wealth slowly and steadily, brick by brick. Now, I'm not going to lie to you. Dividend investing can be a tough nut to crack. It's not just about picking stocks that pay dividends and sitting back to collect the checks. Dividend investing isn't always easy. It requires a lot of research, a keen eye for detail, and a solid understanding of the market dynamics. You need to be constantly aware of the financial health of the companies you're investing in. You've got to be smart, you've got to be patient, and you've got to know what to look for. This means keeping up with financial news, understanding economic indicators, and being able to analyze company reports. One of the biggest challenges is market volatility. The stock market is inherently unpredictable, and prices can fluctuate wildly in response to economic events, political changes, or even rumors. The market can swing up and down like crazy. These fluctuations can be nerve-wracking, especially if you're new to investing. It's easy to get caught up in the daily ups and downs and lose sight of your long-term goals, but don't panic. Remember, you're in it for the long haul. Successful dividend investing is about patience and discipline. It's about weathering the storms and staying focused on your long-term objectives. Don't let short-term fluctuations scare you off. Instead, use them as opportunities to buy quality stocks at a discount. Remember, the goal is to build a portfolio that generates steady, reliable income over time. Another challenge is finding reliable dividend payers. Not all companies that pay dividends are created equal. Some have a long history of paying and increasing dividends, while others might be more erratic. Not all companies that pay dividends are created equal. It's crucial to look at a company's dividend history, payout ratio, and overall financial health. A company with a high dividend yield might seem attractive, but if it's not sustainable, you could be in for a nasty surprise. Some might cut their dividends, leaving you high and dry. This can be particularly devastating if you're relying on that income. That's why it's so important to do thorough research and choose companies with a strong track record. That's why you've got to do your homework. Dive deep into financial statements, understand the business model, and keep an eye on industry trends. The more informed you are, the better your chances of building a successful dividend portfolio. So, how do you find these dividend superstars? It starts with research. You need to dive deep into financial data, scrutinizing every detail to uncover the best opportunities. This means looking at a company's financial statements, understanding their business model, and evaluating their long-term growth prospects. It's not just about finding companies that pay dividends, but those that can sustain and grow their payouts over time. Look for companies with a strong track record of paying dividends. These companies have consistently rewarded their shareholders, often for decades. They have a history of not only paying dividends, but also increasing them regularly. This kind of consistency is a good indicator of a company's financial health and its commitment to returning value to shareholders. These are the companies that have proven they can weather any storm. During economic downturns, they remain resilient, maintaining their dividend payments even when times are tough. This resilience is crucial because it shows that the company has a solid business model and strong financial management. Look for companies that have survived past recessions and come out stronger on the other side. Pay close attention to the dividend payout ratio. This ratio tells you what percentage of a company's earnings are being paid out as dividends. A lower payout ratio is generally better because it means the company is retaining more of its earnings to reinvest in the business or to cushion against future downturns. A high payout ratio might indicate that the company is overextending itself, which could be risky. This tells you what percentage of their earnings a company is paying out as dividends. Lower is usually better. A lower payout ratio means the company has more room to increase its dividends in the future. It also suggests that the company is in a strong financial position, with enough earnings to cover its dividend payments comfortably. It means they have more room to increase their dividends in the future. Companies that can grow their dividends over time are particularly attractive because they provide a growing income stream. This growth can help offset inflation and increase your overall returns. Look for companies with a history of dividend growth and the potential to continue that trend. And don't just chase the highest yields. While a high dividend yield might seem attractive, it can sometimes be a red flag. A yield that's too high might indicate that the stock price has fallen significantly, which could be a sign of trouble. It's important to balance yield with other factors like payout ratio, dividend growth, and the overall health of the company. Sometimes a high yield can be a red flag. It might mean the company is in trouble and investors are dumping the stock. When a company's stock price drops, its dividend yield can artificially inflate. This can be misleading, making the stock appear more attractive than it actually is. Always investigate the reasons behind a high yield before making an investment decision. It might mean the company is in trouble and investors are dumping the stock. Be cautious and do your due diligence. Look beyond the yield and understand the company's fundamentals. A thorough analysis will help you avoid potential pitfalls and find true dividend champions that can provide reliable and growing income over the long term. Section 5, diversification. Don't put all your eggs in one basket. Here's a rule I live by: don't put all your eggs in one basket. This age-old adage is not just a saying, it's a principle that can save you from financial ruin. Imagine if you were carrying a basket full of eggs and you tripped. If all your eggs were in that one basket, they would all break. But if you had spread them out into several baskets, a fall would only break a few eggs, leaving the rest intact. The same goes for dividend investing. When you invest in the stock market, putting all your money into a single stock or even just a couple of stocks can be incredibly risky. Stocks can be volatile, and even the most stable companies can face unexpected downturns. By diversifying your investments, you spread out your risk and increase your chances of maintaining a stable portfolio. Don't put all your money in just one or two stocks. Spread your risk. Think of it like playing poker. If you bet all your chips on one hand, you could lose everything in an instant. But if you spread your bets across multiple hands, you have a better chance of winning some and losing some, but not losing everything. Invest in a variety of sectors like healthcare, technology, and consumer goods. Each sector has its own set of risks and rewards. By spreading your investments across different sectors, you can protect yourself from the downturns that might affect one particular industry. For example, if the technology sector is experiencing a slump, your investments in healthcare or consumer goods might still be performing well. This way, if one sector takes a hit, your entire portfolio won't go down with it. Diversification acts as a buffer, absorbing the shocks from any one sector and keeping your overall portfolio more stable. It's like having a safety net that catches you when you fall. Think of it like a balanced breakfast. Just as your body needs a variety of nutrients to function well, your investment portfolio needs a mix of different assets to perform optimally. A balanced breakfast might include fruits, grains, and proteins, each contributing to your overall health. You wouldn't just eat cereal every day, would you? While cereal might be convenient and tasty, relying on it alone would deprive you of essential nutrients that other foods provide. Similarly, relying on a single type of investment can leave you vulnerable to market fluctuations. You need a mix of different foods to stay healthy. The same principle applies to your investments. A well-diversified portfolio includes a mix of stocks, bonds, and other assets, each playing a role in your financial health. By diversifying, you ensure that you're not overly exposed to the risks of any one investment. Your portfolio is the same way. Just as a balanced diet keeps you healthy, a diversified portfolio keeps your finances robust. So remember, don't put all your eggs in one basket. Spread your investments, manage your risks, and build a portfolio that can weather any storm. Section 6. Supercharging dividends, a unique strategy. Now here's a little secret weapon I like to use: dividend reinvestment. It's like a snowball effect for your wealth. Here's how it works. Instead of pocketing those dividend payments, you automatically reinvest them back into the same stock. This buys you more shares, which means you'll get even more dividends in the future. It's like compound interest on steroids. Over time, those reinvested dividends can really add up, supercharging your returns. Section 7. The power of reinvesting dividends. Let's say you invest $10,000 in a dividend stock that yields 4%. After a year, you'll get $400 in dividends. But instead of spending it, you reinvest it. Now you have $10,400 invested. The next year, you'll earn dividends on $10,400, not just $10,000. And so on and so on. It's like a money-making machine that works for you 24/7. This is the magic of compounding. The earlier you start, the more powerful it becomes. Section 8. Key takeaways for dividend investors. So let's recap. Dividend investing is a powerful way to build wealth over time. Look for companies with a solid track record of paying dividends and strong financials. Diversify your portfolio to reduce risk. And don't forget about the power of dividend reinvestment. It's the secret sauce to supercharging your returns. Remember, investing is a marathon, not a sprint. Be patient, stay disciplined, and you'll be amazed at what you can achieve. Section 9. Ready to grow your wealth? Now, I want to hear from you. What are your favorite dividend stocks? Share your thoughts in the comments below. And don't forget to check out my website for more investing tips and tricks. Let's make some money.